Hello everybody, Jackson here from the Wealth Squad. Today we'll be talking about comparing different companies using valuation metrics, growth metrics, that type of stuff. Before we do that though, just know that when you compare companies, you have to use the same industry. So it has to be under the same industry, every single company, right? If you're comparing, a tech stock, an oil stock, and a farm equipment stock, all those companies, they're going to have different metrics because the businesses are run differently, right? The tech stock, the tech company will of course grow a lot faster than the oil company, especially in the last couple of years. And so when you do that, you'd be like, oh, of course, the tech stock is the one to choose, the best investment. But what you should do is use 3 tech stocks, same type of industry, maybe application software, something like that, and you compare them to find the cheapest one out of valuation and growth standpoint. So let's get into that today. As you can see on my screen is 3 companies, company A, B, and C. We're gonna keep them nameless for now, but you can see there's different valuations for them. This one is worth $3,153. In reality, it's worth like 31 billion, but I brought it down to a point where we could understand it more. Because if I said, 31 billion, 458 million, it's a little more difficult to understand. But after you, take off a couple zeros, it's all just one easy thing to look at. So that's what we're gonna use, and that's what I would recommend you do as well. Just take off a couple zeros, make it the same, cut off 5 zeros or something for every single company you look at, to make it, equivalent essentially. So this company is worth $3,000, $458 in sales within the last 12 months. TTM just means trailing 12 months, so the last 4 quarters, and $86 in profit. Company B is worth $800, $500 in sales, $54 in profit. Company C, $630, $201 in sales, and $18 profit. So that doesn't mean much. Like, just off of that, you can't really tell the best one because the companies are worth different, right? If they're all worth 10 billion, or for this example, $100, then we could see which company generates more profit and more sales just based off that valuation. But they're not valued the same, so we have to dumb it down into valuation metrics, right? This will help us actually look at the company outside of the big numbers and just as a numerical standpoint. So right away, the PE ratio, price divided by earnings, divided by EPS. EPS is just earnings per share. So the stock price divided by how many dollars the company generates per share of stock. Company A is 37, company B 15, company C 36. Right away, company B looks to be the best investment out of the 3, just because 15 PE ratio is less than half of 37, 36. So that 15 just means that the company is trading less per share that the company generates, and that's a good thing, right? If you're investing, you want to buy that company instead of the others, just because each dollar the company generates is cheaper than the others. Then let's look at the profit margin. For company A, it's 18.8%, company B 10.8%, company C 9%. What you could just do is look at this, compare the profit to sales. So 18.8% is a lot better than 10.8 and 9. So of course we're going to say that company A looks really, really good with a large profit margin, as the companies that we're looking at today are in the same industry. 5-year earnings growth rate. So how have these companies grown their earnings in the last 5 years, their profit? Company A 15.5%, B 14.2%, and C 16.1%. Out of the 3, 16.1% does look to be the best, to be the highest, and so we have to continue to look at that. PEG, I'll talk about this in my next video. PEG simply means price earnings growth. So you're getting the PE ratio and dividing it by EPS growth. We're going to go into the specifics in the next video. But under a 1 is good. That means that the earnings that the company is growing is undervalued compared to the actual stock valuation. Over 1 means the opposite. The earnings are overvalued. But a ratio of 1 just means they're fairly valued. So 1.6 is of course the highest, 1.2 second highest, and then 1. So 1 would be the best value here. Then price to cash, just how much cash does a company have. Of course, if a company has a price to cash ratio of 10, that means that every single dollar of cash that they have, the company is worth 10 times that. That's not terrible. As you can see, we're talking about numbers 48.5, 45, and 120. So out of these three, of course, the lowest would be the best. So just based off of this, if we're looking at this industry, what company would be the best to invest in? Let's look. So a PE ratio of 15 is the lowest. That's the best. Profit margin of 18.8% is the highest. That's the best out of the three. 5-year earnings growth rate of 16.1%. That's the best. A PEG of 1. That's the lowest, right? That's the best. And price to cash of 45. That's the lowest. That's the best. So out of this, company B seems to be the best investment. So actually, these are trucking companies, right? Company A, Old Dominion Freight Line, ODFL. It is a strong company, right? You can see that their profit margin is better than everyone else's by a long shot, and they're growing their earnings similarly with everyone else. So they're generating more profit per dollar of sales. But it is overvalued at this price. As you can see, 37 does not indicate an undervalued valuation, right? That just means it's probably higher than it should be. Company B, Knight Swift Transportation, KNX, is the most undervalued company in the three, just growing less than the others. You can see the earnings growth rate is, for the past 5 years, 14.2%, while the others are 16 and 15.5. The profit margin is also hurting compared to Company A, but the valuation does look really good compared to the others, so it still might be worth looking into. Might be the best of the three. And then Company C, SAIA, the fastest growing company of the three, yet second most overvalued. You can see it is growing for the past 5 years at 16.1%, which is better than the others. Profit margin is the worst though out of the three, and the valuation is on par with Company A, so I wouldn't take that into consideration as an investment too much. Then just these stats that we provided today, the PE ratio, profit margin, 5-year earnings growth rate, the PEG, and the price to cash, that's not all you need for an investment, right? You need a lot more than that. To start out with, you need past management endeavors, right? Have they been successful in the past at managing other companies? Company risks, what risk is that company facing where it could lose money, go under? Debt management, how are they handling their debt? Do they have too much, too little? And there is such thing as too little. Cash management, are they handling their cash well? Do they have a lot of it? Do they have a little? How are they doing with acquisitions? Company products, of course, the company products could differ within the industry just by a little, of course. And the business moats surrounding the company, if any, right? We talked about the 7 on our Instagram, and we could talk about those later as well. The 7 business moats to look out for. Just use this way that we talked about to distinguish which company in an industry you're looking into is the most undervalued or overvalued. Based on my opinion, I would say that Company B does look like the best deal, trading at less than half of the others per dollar earned, right? For example, if Company A earns $1 profit, the company is going to be trading at $37, okay? If Company B earns $1 profit, the company's going to be trading at $15. That's a lot better deal, in my opinion, for Company B to be the better investment than A and C. So I would choose B in this scenario, and that is KNX, right? Company B is ticker symbol KNX, if you want to look into it yourself. But just know there's more of this. But just know there's more to investing. If you like this video, please drop a like and comment what I should create a video about next. I'm making videos every Monday, Wednesday, Friday. So, we have time to talk about many things. So, thanks for watching once again, and I'll see you later.